Okay, Chapter 12, we're going to look at some refinements to capital budgeting. Really what we're going to take a look at, initially we're going to talk about the riskiness of doing projects in the corporate context. But then we're also going to talk about some variations, if you will, on the rules of how you ultimately choose between assets. So let's start with risk. Again, up to this time, we pretty much have assumed that all projects have the same risk. However, I'm sure you know that that's rarely ever going to be the chance. No two projects are ever going to have equal risk. Sometimes even similar projects could ultimately have different levels of risk dependent on the cash flows projected, etc. So here we have these two projects, Project A and B. We'll assume that they're essentially identical projects, right? $42,000 is what we're spending for A, $45,000 for B, and of course you can see the the cash flows, and ultimately we end up with very close net present values, $11,071 and $10,924. So they're very, very close with respect to net present value. So how do we ultimately approach the riskiness of projects? So there is a behavioral component. Essentially, this is where we're doing maybe a little bit more subjectivity, if you will, trying to get a feel for the level of project risk. Other kinds of other types of approaches might try to actually place a number on it. So the risk in capital budgeting refers to the uncertainty of the cash flows. So for many projects, this comes, the riskiness almost entirely comes from those cash flows, because in the end, we are forecasting the future. And the longer the project, the longer the forecasting time. One of the ways we can deal with this is something called a scenario analysis. They refer to this as being a behavioral approach. We're going to really make several forecasts. We're going to produce a worst case, an average, and a best case scenario, if you will. And then we're going to analyze the outcomes from those different forecasts or potential outcomes of the project itself. So here we have Project A and B. Again, we're switching projects, right? It says here that for Project A, we're going to spend $10,000. There are our cash flows. And we have obviously different forms of outcomes, and these obviously are going to be applied to calculate the net present value. So down below, the second half, we're going to use, we ultimately then calculate the net present value. And as you see down below here, right, we have a 10% cost of capital and a 15-year life for the cash flows. So we assume what? In a pessimistic, you're going to get $1,500 for 15 years. So here's how we could ultimately calculate. If we kind of page back up, we have our net present values. Here are the potential net present values for A and B, right? The only thing we really haven't applied is what is the probability that those outcomes will happen. In this case, we say there's a 25% chance of an optimistic outcome, 60% chance of average, and 15% of pessimistic. Again, you get this from, or you can use this in the project risk worksheet. So what we find out is the expected net present value for asset A is $55.92, and the expected net present value for B is $6,733. So B has a higher expected average rate of return, but it also has a much higher risk level, right? $2,300 odd dollars for A, $9,500 for B. The coefficient of variation really brings this into focus and shows that the asset B's coefficient of variation is almost 4 times that of A. So asset B is a much riskier project, even though it has higher net present value. Now the question is, the extra net present value, roughly what, $1,200? Is that $1,200 worth almost 4 times the amount of risk? And some might say that that's not enough extra return. So maybe A, based on risk level, is a more beneficial project for the company to follow. We could also utilize something called simulation, and simulation's not that easy to do in in Excel. But essentially, what we're going to do is we're going to apply some probability distributions and random number generators to the variables within a project, and then we're going to do that many times. And in the end, we'll be able to calculate the expected return, standard deviation, etc. for a project. Again, with Excel, this is just not an easily completed process using Excel. We need a higher level of statistical tool in order to simulate this process. What are the international risk considerations, though? I mean, really, we're just looking at cash flow. We want to now look at, well, what about international risk? Obviously, there could be some exchange rate risk. We know in the short term, we could hedge some of this away, but in long term, it may be very difficult to hedge away and even to forecast most of the changes in currency that might happen. So, exchange rate risk is a very important risk that those involved with international projects have to contend with. There was a CFOs, there was a survey done, found out about 40% of the CFOs felt that it was important to adjust the project's cash flows for exchange rate risk, that it's such an important piece and it's so volatile, it makes sense to make an adjustment for the riskiness from dealing with international markets. What about political risks? Political risks are a lot more difficult to deal with. They're much more difficult to protect against. So, we can either adjust the cash flows for some probability of some political interference, or again, we can ultimately just use some type of risk-adjusted discount rate that will help us take into account the potential for political risks. So we just mentioned it. What is this thing called a risk-adjusted discount rate? Well, when we talked about capital budgeting, right, the discount rate that we used was the cost of capital. And in an earlier chapter, we calculated something called the weighted average cost of capital, which is just the cost, the average cost of financing the gathering of funds that corporations undertake. So what we'll need to do is we need to figure out how to adjust that cost of capital in order to adequately take care of or adjust for the risks that are inherent in a particular project. We could use beta, right? We could figure out what is the beta of the project. So we could calculate the beta of a project. Also, we have the security market line formula that we've talked about in other chapters. And of course, we would end up with R sub J here, which is a risk-adjusted discount rate using the capital asset pricing model. Now, the challenge with this is beta, right? We need to have a calculation for a project's beta. How do we do that when projects don't trade? They don't have a rate of return that we can analyze relative to the stock market. So we do have some challenges excuse me, using beta. Excuse me. But there are some upper level adjustments that we could ultimately make that could help us utilize this capital asset pricing model to adjust for this. And of course, how we ultimately use this, we talked about this a little bit earlier. If this is that security market line formula, any projects that find themselves above the line are going to provide a higher rate of return. Their internal rate of return is greater than what the security market line and the theory would project. So anything above the line would ultimately be an acceptable project, and anything below the line would be rejected. How can managers ultimately deal with, though, these risk-adjusted discount rates? How can we characterize projects? How can we actually even quantify them? Well, there's a couple of different ways they talk about. They talk about risk indexes and risk classes. And these are very similar types of concepts, but they can either be subjective or statistical. So let's say we have a project that has a coefficient of variation of greater than 2.7. And that places it, according to our standards, in something called a risk class 4 or maybe risk index 7. So what that does then is says, look, if I'm in a risk index, here is project B for this, ended up with a risk index of 1, then we'd use a required return of 11. Project A had a risk index of 1.6, so we'd have a required rate of return of 14. So if we can figure out a way to classify into these risk indexes, it might be a simpler way to adjust the risk of the project. What about individuals and their needs to diversify? There are some, historically, companies would buy into many different industries in order to diversify the company so that they could reduce the risks. And this is a perfectly good investment strategy. The challenge is, though, the evidence shows that merging with companies is very expensive. So diversification for a corporation typically doesn't provide the kinds of returns that you might expect for them to get, because the costs reduce the overall returns of the company and the projects. It turns out investors can very easily diversify just by spreading their holdings out amongst a variety of companies. So if we're looking to try to diversify the company, that might not be in the best interest of shareholders in the end. We had the other component where we were talking about risk classes, right? So maybe we say, this highest risk class, right? Maybe we would say this is for very risky projects. Below average risk projects are going to be routine replacement projects, right? Level 2 or average risk, right? They involve replacement or renewal of some existing activities on an ongoing basis. But again, the ultimate rule here, the ultimate idea is we want to figure out what this adjusted discount rate is. If class 2 is the average, if something is more risky, in fact, if it's very risky, we want to use a 20% discount rather than the average for the company, which is that 10%. So that's the end of part 1. We're going to move on now, and the next video we'll talk about the actual adjustments to the decision-making process.